Hey guys, welcome back. In this video, we are talking about 83 times the current flow, the real short squeeze, 90% plus upside potential, and many more in this video. First, we're taking a look at this. AMC heating up. Cinema executives are calling 2026 film lineup one of the strongest ever. Think Dune 3, Avengers, Spider-Man, Toy Story 5, and more blockbusters that will push box office to new record sales. AMC's refinancing moves, new Odeon facility plus credit commitment, shows banks betting on the recovery. Analyst sees 50 to 90% plus upside potential. So this is something that we have been waiting for a very long time. Now, already over the past few years, we've talked about the efficiency of AMC. We talked about how even if the box office were to stay the same every single year, our revenue, our profit would still get higher every single year because of the improvements made to AMC. However, what we are seeing now is not only is AMC getting more efficient, but actually the box office is going to get even bigger. This year's lineup is already insane. We've seen at the end of 2025 when Avatar 3 came out, how much of a boost it had to the box office, how much of an impact it had to the box office. And now for me personally, I think the movies we're looking at right now is that of something that could be equal or slightly lower to Avatar 3, but it is still something that will have great effect, great impact on the movie industry, on the box office, and with how AMC is growing this year, with the steps and approach that AMC is taking this year, I definitely see us taking that whole benefit and reaping everything that we've obviously done. What you have to realize is that because of the current fundamentals, because of how well AMC is going to do, as AMC hold these low prices, you will see higher short interest, higher borrow fees, higher FTDs. And that's in fact what we are seeing. Firstly, AMC fails to deliver spikes again. This is the first time since April, May of 2024. Shares were sold but never delivered. So once again, we're seeing this FTD issue becoming rising again for AMC. And we've talked about this before. We've seen how FTDs had effect on AMC. We've seen how FTDs had effect on the ape shares. And now we're seeing it happen again. And we know that when FTDs is spiking, it's precisely because something's happening. And just like what we talked about with box office, just what we talked about with how well AMC is growing, it seems like they're trying to suppress AMC to prevent people from investing into AMC right now. Because people want to prepare for the next few years, because people want to pick the best within the industry, they're trying to make it look like AMC is the worst choice out of the options that you can get. And we already seen that that's obviously not the case. And for me, I feel like they're doing this wrong because the more they suppress this, the more discounted AMC is, the bigger, the more attractive it's going to look for everyone. Because not only are we seeing institutions already buy into AMC, but for apes, it's just going to allow everyone to buy in at a cheaper price. It's just going to be allowed more shares to be bought, forcing the institutions to create more synthetics. And so whilst they think that they can bring the price down and scare investors away, they are actually doing the very opposite. Now, if we take a look at this, let's do some quick AMC stock maths. If we see here, AMC Theaters has a float of 529 million outstanding shares. The average daily shares traded is 36.87 million times 5 days a week, which equals to 184 million. You times that by 4 weeks per month, you get 737 million. You times that by 3 months, you get 2.2 billion shares every quarter. You time that by 4 quarters, you get 8.8 billion shares per year. And then when you times that by 5 years, you get 44 billion shares, which would be, with the current flow, 83 times that. And this is what we've said with, firstly, we still have no idea how many times the float has been sold to us because we've seen data from various amounts. And, these are some of the calculations that we can do. But at the end of the day, we never know to what extent it's actually there. But even here, we can see 83 times the flow. And this is what we said with earlier, with how shorts think that by pushing the price of AMC down, they're going to scare AMC investors off. But actually it's doing the very opposite. When the price of AMC becomes cheaper and cheaper, apes are viewing this as more of a bigger discount and they want to buy even more shares. And so when we buy these shares, we're forcing them to create the float. And already so far, it seems like we've forced them to create at least 83 times the current float of AMC. And it's why I've said, even when AMC makes dilutions, does shares offering, it is not a big deal because people are afraid that when AMC is doing the share offering, they're allowing short sellers to get out. But what you have to understand is that if short sellers have shorted 83 times the float of AMC, giving them 100 million shares, giving them a billion shares, still wouldn't have a massive effect because they've already shorted 83 times, which would be 44 billion shares. So how would 500 million, how would 1 billion shares allow them to get out of the hole that they've dug for themselves when you understand everything that's obviously going on? Another thing, if you want a real short squeeze, you probably want a more levered company where people were truly like it was on the verge of bankruptcy and then suddenly it's not. Now, when you take a look at this and you apply this to AMC, you obviously have that recipe. And you have to realize that once AMC starts to move north, it should be, by any market valuation logic, happen pretty rapidly. No one knows when, but I certainly value being on board when it happens far more than catching the low point. Hence why I've been continue buying and continue to buy on the way down. And it's what we've said, apes are not scared when the price is going down. When you take a look at the influx of capital, you're just seeing more and more people buy into AMC. And this is because what every apes think is pretty much summed up in this sentence. And so it's why we've said that firstly, the float, we've forced them to create at least 44 billion shares. And when we do see AMC move, remember, we're going to be looking at 44 billion shares of shorts being affected. That's going to be an extremely hefty loss for these short sellers. And it's why we talk about how some of the smaller size short sellers would of course be squeezed, would have to get liquidated a margin called first. And that's why we will see the price move extremely rapidly. Do not underestimate the amount of pressure made on short squeeze and gamma squeeze potential with drops in price. Things will get volatile, especially when firms refuse to make an exit, but rather add more exposure down there. That is what is happening. And it's what we've talked about. When we say that, firstly, apes are buying and we force them to create 44 billion synthetics, that's the pressure. That's the pressure that we have created. And that's how much pressure is being built. 44 billion shares worth, and it's being all stored there because apes are continuously buying. The next thing is the shorts rather add more exposure, is why we're seeing these FTDs, why we're looking at fails to delivers spiking again because of what is going on. And so you can see how this is all making sense. And when we take a look at Goldman Sachs, they're saying there's a potential for extreme stock rally. And this is why we've always focused on Goldman Sachs buying into AMC. They are saying to prepare for an extreme stock rally. And some of the preparations they've done is getting rid of the short shares of AMC and buying into long shares of AMC. And so this is how we know that they are worried for what's to come and why we know AMC will very likely to be the center of everything. You can even see here, only 2 million traded in real volume. No sellers left, no liquidity. The fake 15 million in volume is just market makers layering and trading to each other to just make it appear that there are sellers. So what we're looking at is, of course, the off-exchange data. And you can see how it sums up of what is happening, what they're doing, and why they're obviously worried about AMC. And just like what we said with earlier, with the amount of synthetic shares that have been created, you're obviously looking at this here as well. And it's the biggest reasons that they're able to make 44 billion shares, because had they made all 44 billion shares and it was being bought up by the retail and it was hitting the exchange, you would see the price be in the hundreds, if not the thousands already now for AMC. But the way they paired this up and the way that they were allowed and how they've managed to create 44 billions of shares is because they've used off exchange to a big extreme, like what we're seeing here with 85%. And you can see one of these is not like the others. If the fundamentals are so bad that the price deserves to be this low, why go to such lengths to root buyers away from the public eye? This is something I've always talked about, because if AMC was truly a bad company, if everyone truly disliked AMC and was willing to sell AMC, then there will be no need to use the dark pool because naturally the price would be going down. And so people call us delusional for trying to say that AMC should be higher than where it is. We're not saying this with no sort of data backing whatsoever. The reason why we're saying this is because if AMC was bad and it shouldn't go higher, then naturally, even without dark pool, people would be selling, people will be shorting, and the price will be going down. However, what we're seeing right now is that the only reason why AMC is going down is because it's seeing 80% dark pool, 85, potentially sometimes even 90. That's why we know that AMC needs to be higher and it deserves to be higher because it doesn't allow us to have true price discovery. And what's happening here is that this is strange that no one is borrowing shares. What we saw was 4.4 million shares available. Now, this was a massive spike up because it went from 750,000 all the way to 4.4. Now, we've always said this. There is two possible things because of this. Firstly, synthetic shares were created, hence why it went from 750,000 to 4.4 million. The second thing is because of how much institutions have been buying of AMC recently, they are lending out more shares. But either or, what we're seeing that as the more and more shares are being increased, we're seeing how the demand is getting higher. One thing that is happening right now, though, is that when we see shares available to spike up, we know that the demand is there. But when they're not borrowing it, it shows that something is obviously up. And here's why. Because RW and XRT are on the red show more than any other stock or ETF. Coincidentally, these are the ETFs that hold on to the shares of AMC and GME. And so whilst they try and make it look like they're not borrowing shares whilst creating the synthetics, while showing the high available shares to borrow, they're doing this by utilizing ETFs like XRT. And this is something we talked about in the past. And you can even see here another ape buying 1,004 more shares of AMC. And it's just what I've said with people are seeing this as an opportunity to buy more as opposed to an opportunity to sell and get scared and panic. And so these short sellers have done the completely wrong thing, and it's why their margin call is only going to get bigger and bigger, why the liquidation is getting sooner and sooner, and the squeeze price is getting higher and higher. And we can see how brokers are being fined, and why we talked about how brokers help out the institutions, because Robinhood got fined 65 million, and that SEC found retail investors lost 34.1 million more from payment for order flow. And this is what we said with how brokers are not here to help out the retail, but rather the market makers. Something I wanted to show is the reverse repo. We saw it at 0.278, and again, it is just a countdown of going to zero. The very fact we're still seeing it right now at this current number is something that I think is still important. What's more important is also the participating counterparties. You can see it at 4 right now. Previously, we've seen it in the numbers of 70 to 80. Now we're looking at 4. And it just feels like people are trying to find other ways of liquidity, and is why we see the mass panic. You can also see what's happening with silver. About 1.5 million ounces of physical silver removed from COMEX registered stock on Monday. And this is what we've talked about with the price of silver, with the investments of HYMC. Shanghai silver premium widens to 16%. This is also extremely good because we talked about the volatility, but also the bullishness of silver prices as well. Another big thing, insiders are running for their exit. When you take a look at this, so many people are selling shares of their own stock. And it just feels like that they're trying to prepare for something that's about to happen. When we've seen this happen in the past before, it's often led to a massive market crash. And we're just seeing this happen again right now. So it just feels like this next market crash is happening. And it could be aided by this. Brokers joined hedge funds losing money last week, as we see more and more of the world's biggest hedge funds known for their steady returns to suffer hundreds of millions of dollars because of what's going on right now. And this is what we've said. Volatility with the current global politics, news, things, it's affecting the market. It's increasing volatility. And that's making these hedge funds extremely volatile and suffering huge losses. Now, as always, this is the Financial Advisor. Do take us a gram of salt. Make sure to do your own due diligence research, and I'll catch you guys next time.